Hi, John here. In this video, I'm going to discuss how capital gains are taxed in Canada and how you can utilize capital losses to prevent excess taxation. In this video, I'll cover the top 5 things about how capital gains work in Canada. Stay to the end of the video and I'll talk about a number of ways that you can reduce your capital gains taxation. I'm John Woodfield, a portfolio manager and financial advisor with more than 30 years experience. I talk with clients on a regular basis, and frequently the topic of taxation and capital gains arises. What is a capital gain? To explain this, let's use the example of your primary residence or your home. If you sell your home for more than you paid for it, for more than you initially paid, the difference is a capital gain. The second question is, what are capital losses? Well, capital losses are financial losses you incur when you sell an asset for less than you paid for it. Let's say, for example, you buy real estate, a fixer-upper, and you put some money into it and you build it up, but then you sell it for less than you paid for it, including the cost that you put into it. The difference is a capital loss. These losses aren't all doom and gloom though. You might be able to use them to offset capital gains, which may further reduce the taxes you owe on those capital gains. But how are capital gains taxed in Canada? In Canada, a capital gain is the proceeds of a sale less the adjusted cost base. But how does this look in practicality? Well, let's say that you invested in a rental property and you sold it for a certain amount. Your capital gain would be the proceeds from the sale less any costs that you incurred, less the amount that you bought the property for. The difference would be your capital gain. As of this filming, Canada taxes investors on only 50% of a capital gain. As an example, let's say you bought an investment property for $30,000 and you have $5,000 of costs in that property. You subsequently sell it for $100,000. Your capital gain would be the $100,000 less the $35,000, meaning you have a taxable capital gain or a total capital gain of $65,000, half of which is taxable. Let's shift gears and talk about what happens when you have a capital loss. Let's, for example, say that you bought shares in Google and you wanted to hold these shares for a long time, but a family emergency arises and all of a sudden you have to sell the shares at less than what you paid for them. You've incurred a capital loss. Let's say, for example, that you initially paid $300,000 for the Google shares. And when the family emergency arose, you were forced to sell them for $250,000. Which is a difference of $50,000. The good news here is that you can utilize this tax-deductible loss. The bad news is you can only utilize half of it, and you have to utilize it against taxable capital gains. And there's a special twist. In the year of death, and actually the year before passing, you can utilize these capital losses against any form of income, providing that you've used them against the capital gains first. It's like a special parting gift from the Canada Revenue Agency. Now let's talk about those magical moments when you can completely avoid capital gains tax in Canada. The first and one of the most prevalent in Canada is the PRE, or the Principal Residence Exemption. Canadian taxpayers who have a property that qualifies for the PRE can sell it completely tax-free. Also, as an added bonus, if you sell a property and buy a new property within a year, you get what's called the +1 rule. This can be very helpful in reducing your taxes. When more than one property qualifies for the PRE, the one with the greatest capital gain should be selected. Most people don't realize that the rules around what properties can be used for the PRE, the Principal Residence Exemption, is somewhat flexible. For example, vacation properties can sometimes or often be used for the PRE, providing they are ordinarily inhabited. The CRA has quite a loose definition of ordinarily inhabited, so working with an accountant or a financial advisor can help point you in the right direction. There are also situations where a property could be deemed to be sold, even though it may not have been sold. This is called a deemed disposition and can create taxable capital gains. We go into this more in our blogs, so please look there for further details. So how can you avoid capital gains in Canada? Well, you cannot avoid death or taxes, as we all know. There are a number of things that you can do to reduce your taxes and reduce your capital gains in Canada. We've covered 3 of them already. Now here are 4 more ways you can reduce your capital gains in Canada. The first way is you could shelter tax and capital gains by funding an RRSP, TFSA, and/or an RESP in Canada. Each one of these plans has various funding rules and requirements, but they all are a great way to save money in taxes. The second way is you could donate shares to a charity in kind. Rather than cashing out the shares, you would donate them in their original form, and this eliminates the capital gain you would otherwise incur, and you still get the tax break for the donation. The third way is you may be able to take advantage of the lifetime capital gains exemption, LCGE, if you sell qualified property, such as shares of a small business corporation and certain interests in farming or fishing properties. When transferring property or business to a family member, you may be able to spread the tax burden out over a few years to take advantage of the progressive tax rate. This is more complicated, so we strongly suggest you talk to a professional, such as an accountant, about this strategy. Just because you've made money doesn't mean you have to give it all away in taxes. Tax planning is a vital part of investment and financial planning, so making sure you have all your I's dotted and T's crossed makes a huge difference to your outcomes. Finally, if you're planning a cross-border move or you're already living in Canada and need help with your investment portfolio, please contact a Swan Wealth advisor to book a call. Thank you for tuning into this video, and we look forward to seeing you soon.